Imagine your 70-year-old self could sit you down and say, here's what I'd wish you'd done differently in your 60s. I've helped many people retire well, and I've listened to just as many share what they do differently. The wins, the regrets, and the subtle oversights they didn't see coming because they were focused on the wrong things. Well, in this video, I'm going to reveal their lessons, their hindsight, giving you the opportunity to act on them. First lesson from those in their 70s, they say, I should have retired a couple years earlier. I can't tell you how many people I've met who worked longer than they needed to because they didn't know how to shift from saving to spending. They have a vague sense of their investments, but no actual plan for how to turn that into income, and that created fear, or at least hesitation. They didn't know if they could sustain their spending, let alone their travel, help their grandkids, or give generously without risking their future. So let me share a real-life spending plan of Jeff and Mary. He's 64, she's 63. They have $3 million in investment accounts, and they want to retire. Their expenses are over $16,000 a month. That includes $9,000 of core living costs, plus travel, charitable giving, private medical insurance until Medicare kicks in, and a mortgage they'll carry for a few more years. Now, the 4% withdrawal rule is common to calculate retirement income. It says you can safely withdraw about 4% of your portfolio each year and then boost for inflation. A good starting point. But in their case, that would mean about $10,000 per month. But if they stuck to that, they'd be short by $6,000 because their Social Security hasn't started yet. Jeff plans to start his at 70, Mary at 67. That delay creates a gap now, and their expenses are higher right now. So that could either force them to take Social Security earlier. They could pay off the mortgage early to reduce expenses, but they have a low fixed rate and it would take money out of their pot. Instead of a fixed withdrawal rate, we want a plan that adjusts to these different income phases. The early years where their expenses are high and they draw more from their portfolio, which might exceed the 4% withdrawal rate, but the later years will have Social Security kick in. Here's where a dynamic spending plan adjusts for the reality of retirement, uneven income sources and expenses. Mapping it out lets them go beyond the rule of thumb. Most people that retire around 65 or earlier, they'll see this hatchet shape where you might draw more early on from your investments before pensions or Social Security kicks in, and then less later when those fixed sources arrive. Well, a dynamic plan lets you spend with confidence now, knowing your future income and expenses can adjust. But that's just the beginning. With a well-designed plan, Jeff and Mary can meet their spending need of $16,000 per month, and we've shown that they could actually spend $18,000 per month today if we have a system in place to monitor spending. They know the mortgage will drop off. They know insurance costs will shift when Medicare begins. And they know Social Security will eventually reduce the pressure on the portfolio. So what makes this work is the dynamic risk-based guardrail system. These adjust with their portfolio. If markets perform well and their $3 million grows to $5.1 million, their plan allows them to increase spending by $7,100 per month. It's telling them things are really strong. They can celebrate, upgrade, travel, give more. But what if the market turns and their portfolio drops to $1.7 million? Well, they need to tighten the belt by $500 per month. None of us can control the markets, so it's about having a smart framework to manage risk. And this is risk on both sides. We tend to think of risk as overspending, and certainly that should be well planned for. But we also want to manage the risk of underspending. Having a spending plan you can be confident in can allow you to have that permission to spend or even give more. But getting to the point of a confident spending plan won't be accomplished unless you get this next lesson. I see often when new clients, they come to us, they have scattered accounts, multiple advisors, assets at different custodians. Some even explain it as diversification, but it's not. It's confusion. Real diversification happens inside the portfolio. What they have instead is fragmentation. Different advisors give different advice. Gaps open up. No one's talking to each other. Opportunities get missed. So how can you be organized and clear without having all your eggs in one basket? Well, here's my opinion, and you can comment as to what you think is most important. First, pick a custodian for your investments. Popular ones like Schwab, Fidelity, Vanguard. They all have a solid track record of doing their number one job of safekeeping your investment shares. The cross-custodian account management makes life unnecessarily complicated according to those well into retirement. Now, yes, for your actual investments, be diversified. Don't have all your eggs in one basket because different parts of the markets and in the economy work in cycles. Next, build a team of professionals like a CFP, a CPA, estate planning attorney, an insurance broker, even a Medicare specialist can help you evaluate your plan periodically. But don't duplicate these professions. Instead, pick the best for you in each area and then allow them to work in coordination. Finally, track your assets. Have a dashboard, preferably a personal website that updates your asset values, or at the very least, a spreadsheet that shows all that you own and owe. When you have clarity, you greatly improve your probabilities of making better decisions and make life easier. Now, let's go back to Jeff and Mary for lesson number 3, because their situation is common to so many retirees in their 60s. When they retire, they'll have this window where they take income from their investments, not yet started Social Security, they don't yet have required minimum distributions from their pre-tax IRAs, for which, in Jeff and Mary's case, they have 2/3 of their portfolio. The opportunity is this tax valley of about 4 years where their taxes will be incredibly low. Rather than treat this like a windfall, we want to take advantage of it, because the tax bomb from those pre-tax IRAs is waiting when you get into your 70s, which many people regret not being proactive. What we helped Jeff and Mary do was use that tax valley for Roth conversions. An alternative is to at least take some IRA income now at low rates. Paying tax now on purpose isn't fun, but if you don't do it, the IRS will do it later and on their terms, not yours. By shifting some of that pre-tax money into Roth accounts now, they can do so at low tax rates, giving them more flexibility, less taxable income, and more control over RMDs, and a portfolio that's better positioned for longevity. Now let's take this a step further. When you transition from a saver during your working years to an income taker in retirement, some of you are already there, the planning really does change. Now in recent years, we had the COVID crash down some 35%, but a fast bounce back. 2022, stocks and bonds were both hit, but again, a fairly quick recovery. What we can forget is that the average bear market in stocks lasts about 3 years when you go from peak back to peak. In the major ones like the 1970s, the dot-com crash in 2000, and the 2008 financial crisis lasted 6 to 7 years from peak back to peak. Well, a 79-year-old today was 62 in 2008. The great financial crisis hit differently for that person because losing half the market value over a year and a half with a slow recovery was difficult for that person that was just retired or getting ready to retire. So that 79-year-old would simply say to have a cushion. We like to call it a war chest. Let me show you why this works. So let's say you need $90,000 per year from your portfolio and you have $2 million saved. Well, a 3-year war chest would be about $270,000 or about 14% of your portfolio. That money sits in conservative assets, cash or short-term bonds, not for growth, but for stability. Now, someone more conservative might want 7 years of reserves. Well, in this case, that would be about 31% of the portfolio. If the market drops, you draw from the war chest instead of selling stocks. When things recover, you can rebalance and replenish. It's a buffer against bad timing and the cycles of the market. It's your preference, but the principle stands. Don't force yourself to sell in a down market and sleep better at night when adversity hits. Now, this is interesting. My 70-year-old clients talk more about their trips than their portfolios when we meet because the investments are just the tool to live out what they really value. However, I talked with a client recently who she loves to travel, but hasn't been on any trips in the last few years. I asked her why, and then I encouraged her to do what she loves, and we confirmed that she has the money. She just needed that boost, and she's planning that next trip. That's not uncommon. We say we value things, but our spending doesn't always reflect it. And that's the lesson. Your money should support the life you actually want to live. That could be travel. It could be family experiences, mission trips, or going to concerts. Maybe it's seeing a World Series. When you're in your 60s, the intersection of good health, time, and having the money is likely at a high. Use that time and the money to live out those values. And this freedom in your 60s can be prolonged. My clients in their 70s, they talk about the need to stay active mentally and physically. But those habits, and even maintaining physical strength, needs to start early. A Penn State study showed that strength training at least twice per week was associated with a 46% lower risk of death. Muscle mass, strength, and power, they all decline with age by 3 to 8% per decade after age 30. And the rate of loss accelerates after 60, making it all the more important to stay active. But it's not just about living longer, it's about having the capacity to live well. Research shows that staying active, especially through strength or resistance training, is one of the best ways to prevent muscle loss, weakness, and frailty as we age, it helps you stay mobile, independent, and healthy, both physically and mentally. Your 60s are the ideal window to build strength that carries you through your 70s and your 80s. But this too is a financial issue. Keep up on that strength training twice a week, walking, staying mobile. It's for your health, your quality of life, but also for your savings, because that's going to thank you. Research studies have shown that preventative care programs reduce healthcare costs for aging adults and keep more money in your pocket. And finally, maybe most importantly, invest in your people. I was just talking with a new client the other day who said, I didn't realize how much I would miss the relationships since I retired. The CDC says 1 in 4 Americans over 65 are socially isolated, and loneliness has been linked to a 29% higher risk of heart disease and a 32% higher risk of stroke. It's not just emotional, it's physical, mental, and financial. Medicare spends an estimated $6.7 billion more each year on socially isolated older adults, according to AARP. Many people think that won't happen to me. I'm married, I'm busy. But as routines fade, careers end, and kids move away, that connection erodes unless it's built intentionally. Make this part of your plan. Be intentional with your friends and family. Join a group in your community. Volunteer. Invest into your personal connections now, and you'll benefit in later years. Because retirement isn't just about income and investments. It's about who you're spending it with. It's about getting the most out of life from the money you've saved. And the earlier you act on these lessons, the better your outcomes will be. Now, if you really want to get that spending plan down, the next video you need to watch, my partner Alex breaks down how much you can really spend with a $3 million portfolio. You can find that here. And if you would like to talk with me and my team about how we can help map out your retirement future, you can schedule a brief call by clicking on the link in the description. Thanks for watching.